So imagine a stock surges, like over 7% in a single day, but it's actually down nearly 30% this year.
Oh, wow.
Right? I mean, is it flashing major sell signals in a falling trend, or is it this misunderstood, undervalued gem just screaming, buy?
It is the ultimate puzzle for anyone watching the markets right now. You have this massive short-term pop acting as almost a smike screen over some very intense structural long-term pain.
Yeah, totally.
And for anyone actually holding the stock, it creates an incredibly stressful psychological tug of war.
Which is exactly why our mission today on April 15th, 2026 is to just cut right through that noise.
Yep.
We're taking a hard look at the data, the underlying mechanisms, and the actual debate between the bull and bear cases of BigBear.ai Holdings, Inc.
Ticker symbol BBAI.
Exactly, BEAI. If you're holding it right now, you are probably staring at your screen wondering if you've been trapped by the AI hype cycle, or if you were, getting in on the ground floor of a massive defense tech pivot.
But real quick, before we dissect the mechanics of this highly volatile stock, we need to explicitly state that this deep dive is just an educational analysis of market data and multiple viewpoints.
Yep.
We are mapping out the landscape of a complex asset, but this is absolutely not financial advice.
Essential disclaimer, always. And hey, before we really get into the weeds, please remember to like the video and subscribe to our YouTube channel.
And leaving your feedback in the comments is pretty much compulsory for this one. We need to hear your take.
Yes, absolutely. Okay, so let's get right into the immediate battlefield of the stock price, because the order flow and the price action are telling two, well, very different stories.
Yeah, they really are.
As of our focus date today, April 15th, BBAI closed at $3.79. That is a robust 7.67% daily bump.
Right, and in overnight trading, it pushed even higher, reaching around 390.
But when you pull the lens back, the picture gets incredibly murky. Over the last 6 months, it has experienced a brutal 55% drop.
55%.
Yeah. Though, to be fair, we have seen a 13.4% rebound over the past week.
The 52-week range is really the context you need to absorb here. We're talking about a low of $2.36 and a high of $9.39.
That is a massive spread.
Huge. And that kind of spread immediately signals that this equity is driven by extremes in sentiment. It basically creates a perfectly designed trap for retail traders.
How so? Like, why are retail traders specifically getting caught?
Well, human nature just makes us react to that daily 7% pop. The green on the screen feels like a victory, But while a trader is celebrating a single up day, they are often completely missing the broader medium-term falling trend channel.
Which recently broke through support at $3.60, right?
Exactly.
It's like a speculative rocket fueled by AI hype that's either going to launch or just completely explode on the pad.
That's a great way to put it.
And when we look at who's actually moving the money, the data gets even more conflicting. Back in December 2025, there was notable institutional accumulation. Like, the big money was buying in.
Right.
But our recent 2026 data shows a company director selling off 80,000 shares.
Ouch.
So let's unpack this. When a director unloads 80,000 shares right after a 55% 6-month drop, how should you, the listener, weigh that against the older institutional buying?
Well, that is the multi-million-dollar question right there. December 2025 is frankly an eternity ago in a volatile tech market.
Fair point.
Institutions operate on very complex timelines. They might have been positioning for a macroeconomic shift or setting up delta-neutral trades. But an insider selling after a 55% drop is a very clear signal.
Because they're taking a huge loss, essentially.
Right, or at least leaving a lot of value on the table. Insiders sell for a variety of reasons: tax obligations, diversifying their portfolio, but selling into that kind of structural weakness rarely indicates confidence in an immediate V-shaped turnaround.
Right.
They're looking at the exact same data we are, and they are choosing liquidity over potential upside.
So we have a fundamental disconnect. We have insider selling, we have retail traders getting whipped around by daily volatility, and we have a stock price that feels untethered from reality.
Completely untethered.
To understand the engine driving this, we have to open up the books and look at the financials. And the income statement is, it's frankly a really tough read.
It's not pretty.
No. For fiscal year 2025, total revenue was $127.7 million. That's down 1.1% year over year.
Hmm.
But quarter four is where the alarm bells really start ringing.
Oh, yeah.
Revenue fell 37.7% year over year to just $27.3 million.
A nearly 40% deceleration in a single quarter is not just a rounding error. That represents a structural shock to the business model.
And you see that shock flow directly down to the bottom line. The net losses are widening aggressively. They are sitting at a negative 82 cents earnings per share on a trailing 12-month basis.
Right.
In Q4 alone, they bled $5.823 million. Though, to be fair, 2026 estimates suggest an improved EPS of negative 21 cents.
Still negative, though.
Still negative.
Yeah.
But here is the piece of data that really caught my eye. Their gross margins collapsed from 37.4% down to 20.3%.
That is a brutal margin compression.
Right, and this is where it gets weird paradoxically. When you look at the balance sheet, their cash position actually doubled recently.
Yep.
Their working capital improved significantly from a deficit to a positive $145.02 million.
Which is huge for their liquidity.
Exactly. And total assets are sitting at $894.55 million against total liabilities of $282.68 million.
They do also have total debt sitting at $114.8 million, which we can't ignore.
True. But looking at all of this, I have this analogy in my head. They have double the cash, but their Q4 revenue dropped almost 38% and margins collapsed. It feels a bit like finding a crisp $100 bill on the sidewalk while your house is actively burning down.
I love that.
Which fire is the biggest threat here?
Well, the liquidity and the operations are telling two completely different stories. That doubled cash position and the $145 million in working capital, that is a vital lifeline.
Okay.
It means BigBear.ai isn't facing an existential bankruptcy threat tomorrow. They have the runway to keep the lights on, service that debt, and attempt to turn around.
Right. They bought themselves time.
Exactly. But remaining cash flow negative from operations, especially with gross margins collapsing to 20%, means the actual cost of delivering their services is eating up all their operational capital. That is the fundamental anchor dragging the company down.
But why are the margins collapsing so fast?
It's likely tied to their transition. They are trying to move away from lower margin legacy government consulting work. When a company pivots from, trading hours for dollars toward building scalable AI software platforms, they have to eat massive upfront infrastructure and R&D costs before the new revenue streams catch up.
That makes sense.
Yeah.
But the algorithms don't care about a transitional narrative, right?
Yeah.
They only care about momentum.
Exactly. The algorithms are ruthless.
And right now, the algorithmic trading is punishing this fundamental disconnect brutally. Let's look at the technical charts because the metrics are flashing intense warning signs.
Let's do it.
Immediate support is down at $2.99. Resistance is sitting at $3.77, and that newly broken $3.60 level.
Right, which was key support until recently.
Yep. And the moving averages are screaming strong sell. BEAI is trading below both the 50-day simple moving average, which is sitting around 386 to 397, and the 200-day average, which is way up in the clouds at 547 to 579.
And the oscillators completely validate that downward momentum.
What are they showing?
The 14-day RSI is at 40.04, so neutral to oversold. But the more critical metric here is the MACD, sitting at negative 0.20.
And that's a sell signal.
A strong one. A MACD at that level isn't just a generic bearish indicator. It tells us the short-term algorithmic selling pressure is actively accelerating away from the longer-term trend. Despite these occasional 7% daily relief rallies, the speed of the sell-off is actually increasing.
Wow. And here's where it gets really interesting for me. The sources point out a failed Wyckoff accumulation structure.
Yes, the Wyckoff failure.
For the listener who isn't staring at charts all day, what does an accumulation failing actually mean? Is that just a fancy technical way of saying the floor fell through?
Basically, yes. So an accumulation phase usually looks like a sideways trading range where a stock is building a base. The theory is that institutional smart money is quietly absorbing the supply of shares from retail traders who have just given up.
Right, so they're loading up before a breakout.
Exactly. But the critical word in this scenario is failed. A failed accumulation means that base wasn't a launching pad at all. The institutional demand simply wasn't there to absorb the floating supply.
So instead of breaking out to the upside, it just tanks.
Right. It signals underlying technical weakness rather than a healthy consolidation phase. When that support level breaks, it triggers a cascade of algorithmic stop losses.
Ouch.
So even with a daily pop, that failed wick-off structure confirms the short-term weakness and bearish momentum. The market tried to build a floor, realized there was nothing underneath it, and collapsed.
Which brings us to the most fascinating contradiction in this entire deep dive. The technicals are flashing bright red, the operations are bleeding cash.
Yeah.
Yet when we look at the analyst consensus ratings, BAI sits at a hold with a score of 2.00.
It's wild.
And the price targets are averaging $5.33. They range from a low of $5 to a high of $6.
Right.
If it hits that 533 average from where it is today, that's a massive 44% plus upside.
It's a huge potential swing.
So this brings us to the ultimate debate. Is BBAI a hidden, undervalued opportunity, or is it a textbook value trap?
Well, let's lay out the bear case first, because the value trap argument is incredibly compelling when you look at traditional metrics.
Let's hear it.
BII currently holds a $1.8 billion market capitalization for an unprofitable company with revenues shrinking by nearly 40% in its most recent quarter.
Yeah, that's deep.
A $1.8 billion valuation requires a massive suspension of disbelief.
Totally. It carries a Zacks value score of F. And when you value the company based strictly on sales, it's trading at 6.07 times its price-to-sales ratio.
Which is astronomical.
Right. To put that in perspective for the listener, the industry median is only 1.90. So I have to challenge the bull case here. They are trading at over 6 times their sales when the median is under 2, and they get an F for value.
Yep.
Doesn't this $1.8 billion market cap for shrinking revenue define a classic value trap where retail traders get lured in by the AI buzzword?
I mean, it is entirely rational to look at an F value score and a 6x sales multiple and conclude this equity is radioactive.
Exactly.
In almost any other sector, it would be. But to fairly evaluate the bull case to see why some call it undervalued, we have to look at the specific underlying assets BigBear.ai controls.
What do they have that's so special?
They possess a legitimately strong entrenched presence in national security and global supply chain AI. They aren't building a generic consumer app.
Right. Plus, there are some strategic leadership changes, right? A new chief human resources officer and a chief commercial administration officer pushing for global expansion.
Exactly. But you have to remember, the market often prices in a premium for companies entrenched in sticky, high-barrier sectors like national security.
Because it's so hard for competitors to get in.
Precisely. Getting a top-secret security clearances, achieving authority to operate on classified military networks, these take years and millions of dollars. The bulls view the current cash burn and revenue drops as the painful friction of pivoting a massive ship. They're betting on future potential over current reality.
Okay, so having weighed the bullish dreams against the bearish realities, we need to map out what this means for the stock's actual timeline.
The outlook is key here.
Right. So in the short term, meaning the next few days and weeks, the outlook remains dominated by bearish sentiment due to the missed revenue guidance and technical breakdowns.
But there's a massive upcoming catalyst.
April 30th, 2026.
Yeah.
The Q1 earnings report.
That report is going to be a make-or-break crucible. The market will be aggressively scrutinizing the numbers to see if that 38% revenue drop was a temporary blip or the beginning of a fatal decline.
And looking past the short term into the medium to long term, the outlook is undeniably high risk.
Extremely high risk.
Survival and growth entirely depend on a massive business pivot. They have to transition from low-margin government work to high-margin commercial platform contracts.
And that transition is notoriously difficult to execute.
Why is it so hard?
Well, selling to the government usually involves custom consulting engagements. You are trading human hours for dollars, which limits your scale and compresses your margins, hence the 20% gross margin.
Right.
Commercial platform contracts rely on a software-as-a-service model. You build it once, you sell access 1,000 times. The gross margins there can easily hit 70 or 80%.
So, synthesizing this for you, the listener, what does this all mean? In the short term, we are all holding our breath for April 30th to see if they can stop the bleeding. But in the long term, they absolutely have to prove they can sell high-margin tech to the commercial sector, not just the government.
That is the ultimate test of the new leadership team. If they pull it off, it's highly lucrative. If they fail, that $1.8 billion market cap will crash to meet the harsh reality of their operations.
This has been an incredibly intense deep dive into a stock that is just pulling the market in two entirely different directions. To briefly recap the duality of BBAI, you have a technically broken, fundamentally struggling company,
Right.
but it still holds a $1.8 billion valuation due to its foothold in national security AI in these upcoming leadership pivots.
It's a profound tug of war.
And this is where we turn it over to you. We want to hear your perspective. Drop a comment below with your own take. Are you bullish or bearish on BEAI?
Yeah, let us know.
Do you see a value trap or an undervalued opportunity? Please make sure to like and subscribe to the YouTube channel so we can keep bringing you these deep dives. And reinforce again, everything we unpacked today was purely for educational purposes and not financial advice.
Absolutely. And as you weigh the bull and bear cases, I want to leave you with a final provocative thought derived from the sources.
Let's hear it.
With that Q1 earnings call looming on April 30th, the real question isn't just what the company will say on the call.
Okay, what is it?
It's what the options chain activity is quietly doing in the background right now. Are large institutional traders quietly placing massive directional bets while retail traders are distracted by the daily volatility?
Wow.
That hidden options flow. That is the thread you should pull on next.